All right, you ready? Go ahead.
Tax policy is a major part of the political discrepancies in the United States. This includes what is taxed, how much it is taxed by, and what deductions are offered to reduce a person's tax liability. Given that the election was only a few weeks ago, I believe it is important to understand both sides of the tax policy debate, specifically taxing the rich. This idea is called a wealth tax, or a tax on someone's assets instead of their income. The IRS outlines distinct differences between assets and income. Assets are items owned by a taxpayer with economic value, and income is any sort of earnings received in exchange for labor or products. Some argue that a wealth tax will make economies with large wealth disparities more equal by redistributing wealth, while others say that it will end up hurting the economy by discouraging investments and hurting those with low income and high net assets. The United States currently uses an income tax policy, which is tax on wages, rental property, interest, dividends, or any amount earned by a taxpayer. According to Michelle Scott in an article on Investopedia, Senator Elizabeth Warren constructed the Ultra Millionaire Tax Act, which follows the idea of taxing assets like someone's car, house, paintings, shares, and more. She proposes to enforce a 2% tax on a person's net assets between $50 million and $1 billion, while amounts over $1 billion will be subject to a 3% tax. This was presented to Congress back in 2021, and while the bill died after its second reading, she presented it again in March 2024. It is important to note that this wealth tax is only for taxpayers with amounts over $50 million in assets. There's no tax on anyone with net assets under that amount, not even 1%. But it would require every taxpayer to report the value of each asset they own, which has been proven difficult in other countries who have attempted to adopt a wealth tax. As it's pointed out in an opinion article through Politico, it's asking people to tell the government an honest number of how much their property is worth so that the government can tax it all. Even assuming that taxpayers report all of their property, what are the chances it's reported at the right value? For those that support the idea of implementing a wealth tax, their argument stems from helping those with lower income. They feel that taxing the rich would take money away from those who don't need it and give it to people who need it more. This is especially prevalent for the Democratic Party, who want to acknowledge the difference in economic statuses across the United States. This is what makes taxing the rich a social justice issue. The belief is that the upper class has significantly better economic standing compared to lower and middle classes, especially in terms of tax brackets and investment numbers. According to a Brookings article, the bottom 80% of the population earn their income from wages, and the top 0.01% earns 85% of their income from investments. The issue is, investments are broken up into 3 tax brackets based on income. The lowest income range is taxed at 0%, meaning most of the lower and middle class don't pay tax on their investments. But the idea there is that most of the lower and middle class don't make enough money to invest. The middle group is taxed at 15%, and the highest income range is taxed at 20%. In comparison, there are 7 tax brackets for a person's wages, and those range from 10 to 30%. Those who support a wealth tax see that the wealthy are not taxed at their normal 32 to 37% rate because most of their income are investments taxed at 20%. The reason why investments are taxed at different rates than regular income is because the lower tax is meant to encourage investments into the economy, according to the opposition. If a wealth tax is implemented, that wealthy 0.01% of the population will either have to pay 2 to 3% tax on their stocks and other assets, or a new tax law will be put in place to raise the tax on investment gains. So instead of that 20% tax affecting most of their investment income, it could be raised to that 32 to 37% rate that income is taxed at. The Republican Party tends to vote against raising investment and wealth taxes because typically when taxes are involved, taxpayers and companies will do anything to pay less. There's also the issue of illiquid assets. Liquid assets are items that can easily be turned into cash, like loans or stocks, while illiquid assets are not easily turned into cash. For example, under a wealth tax, if a farmer has an expensive tractor and high-value land, he will have to report those and pay tax for them, but he might not have the funds ready to pay for that higher tax, especially since land's value increases with time. So those who oppose a tax on a person's assets believe that investments will decrease, hurting the economy, and it will negatively impact taxpayers with high-value assets and low income like farmers. A wealth tax would have significant impact on the preparation of financial statements for companies. Managers currently have to choose between 3 different inventory costing methods because of taxes. By showing high inventory, a company looks better for investors with lots of products, but because their cost of goods sold is low, their taxable income is high. So most companies will report low inventory to decrease their taxable income. Shifting from taxing income to assets, companies would find similar ways to write off their assets to report lower values just to pay less tax. To sum it all up, those who support what is called the wealth tax believe it will generate more revenue for redistribution to those with lower income because it taxes a person's belongings instead of their wages, while the opposition see the idea as harmful to the economy for investment and equality purposes.